So, hello, very warm welcome from the enmacc offices here in Munich. Happy to be back with another episode of the Digital Trader Summit. We want to look at EUAs, at the carbon markets, European carbon markets to be exact, because I felt we have not paid enough attention this year to what's going on there. Prices were moving a little bit sideways. We had no big policy events in 24. So at least speaking for myself, I haven't dealt a lot with the EUA markets this year while we're trading significant volumes by now on the platform. So it's time to invite another guest. We have Ingvild with us from Veyt. She's managing the EU carbon markets and has an excellent knowledge and insight in what's going on. And spoiler alert, I think 25 will be much more interesting. So I'm looking forward to this presentation and as well your questions as an audience. So please, again, use the chat or the Q&A function of Zoom during the presentation or afterwards to bring up your questions. I will pick them up and discuss them later after the presentation. Looking forward to an engaging discussion. Ingvild, the floor is yours. I hand over to you and we'll listen.
Thank you, Jens, and hi everyone. Greetings from Oslo. So I'll first kind of go through some slides with you, and then I'll go over to kind of having a discussion with Jens. Let me see there if I hit the right button here, then you will see my slides as well. Go a little bit into kind of the EU market dynamics and outlook, navigating the path forward, focusing then on 24 and 25. So I'm representing Veyt. So we are a market intelligence company covering low carbon solutions, doing market analysis on renewable power, renewable fuels, and carbon, then both compliance carbon and voluntary carbon. But for the exciting topic today is the EU ETS, my favorite thing to talk about. So the EUA pricing dynamic, a bit kind of what is the current landscape and the key drivers. What's up for Q4, and also kind of looking into 2025, what do we expect for carbon in 2025? So going into kind of a bit looking back, step back, seeing, okay, what happened this year. I mean, we came out from 2023, which was kind of a high carbon price year, I would say. And then we started the year off at this year's high before we was just like going down and down and down up to 51 euro per ton. It was mainly kind of weakness in the gas market. That was the main driver of why we kind of saw carbon price moving lower. Already in December, we had, ahead of really kind of the winter season, we had gas in the money over coal. So of course, kind of less emissions from the power sector was also kind of on the horizon. So then it was kind of driving the price low to kind of the 50 levels. Then when we saw kind of gas rebounded, carbon was following much of the same. And the whole of 2024 has been dominated by weak fundamentals. I will go into kind of a bit on the emission parts in a few slides. But over summer, it was also kind of this, in August, we had the first August with full auction supply. Normally, it's kind of half the auction supply in August because, people are on holidays, not too high demand in August. And then ahead of this, it was kind of nervousness in the market. How will kind of the market absorb these like large volumes coming to the market in August? August started auctions, high interest. So then that was kind of a bit of a price support then in August. Then we have also kind of option expiry, September option expiry influencing the market in September. We had the compliance deadline for 2023 emission for the first time in September this year. And it really kind of didn't provide too much kind of support to the prices, but it was more kind of on the option prices around kind of 65, 62. That was kind of, it fluctuated between. We had kind of another dive now not too long ago, we had the prices diving down to 60. We've seen kind of 60 providing quite a solid price support at the moment. So now we're kind of back up again. I guess also kind of prices yesterday was closing above 65 again. So it kind of seems to be that 60 is now holding. It seems to be quite kind of an attractive level to enter the market. But then, of course, kind of you can say that we have had low prices this year, and of course we have had lower prices in 23 and 22. The chart to the right shows kind of the average prices for the previous years. We're still kind of quite much higher than the prices, the average prices of 2021. So just to give it kind of a little bit of context price-wise. Okay, gas. Carbon has not kind of living its life on its own this year. It's been kind of much kind of, what is gas doing? I'll follow. So that's kind of the thing that has really kind of happened. I mean, with the correlation, we've seen a super high correlation for gas and carbon this year. It's kind of looking back on the history. It's never been as highly correlated as now. Of course, kind of the latter half, kind of after summer, we're seeing kind of sometimes it's actually diverting a bit, where kind of correlation is lost for a while before it kind of gets back up again. So lately, it's kind of not necessarily kind of only gas is the only explanation why, but that's kind of at least what we see for gas. And then again, is that because we've kind of seen the fuel switching dynamics? No, not necessarily. That's the case. The brownish lines are showing the CO2 fuel switching price for 39% efficient coal to 50% efficient gas power plants. And when the EUA price, the blue line, is above the brown lines or the fuel switching price, then it's gas that is favored over coal and vice versa. So most of this year we've kind of seen, I mean, carbon prices could have been considerably higher without triggering kind of more coal-fired power generation. But still kind of it's still have taken so closely correct direction from the gas market. We have seen kind of in August, September, moving into like closer to winter and closer to next year, we've seen kind of the increase in gas prices has not been kind of mirrored as such in the carbon space, and now we're seeing kind of a bit the fuel switching dynamic has kind of favored now coal over gas, whilst we haven't really seen that taking a big kind of impact on the carbon prices as such. So I said it was going to have been kind of a weak fundamental year for carbon. We have seen this is showing kind of the yearly power sector emissions. The blue line is then year to date for 2024. We know that emissions were dropping heavily last year. But then again, this year, we see kind of an even further decrease of the power sector emissions. And why is that? Yes, I said kind of we already had like gas in the money when we're entering the year, even through winter. But we have also seen kind of like on the power production side, we've seen kind of an increase in power production. But it's kind of the build out, kind of steady build out of wind and also kind of solar that has kind of offset really kind of the increase in power demand. But what is really kind of special also this year is that the very solid hydro situation, especially in Iberia and in the Alps, that we've seen kind of much healthier hydro levels and hydro production than in the previous years. Also kind of solid production, nukes production in France, which means less room for the emission intensive power generation. So that's why we're seeing kind of this continued large drop in power sector emissions. What about industry? I mean, it's been kind of some rough years also for European industry. However, we see like in some sectors, some industrial sectors, we see kind of a signs of recovery. I mean, it's kind of up from last year when you look at the industrial production, except for cement. However, if we compare it to where we were like to 2022 and also pre-COVID in 2019, we see kind of we're quite far behind what was like pre-COVID levels in terms of industrial production in Europe. Just kind of took a snapshot from the confidence indicator for industry from Eurostat. The blue line is showing the Eurozone and the orange line is showing Germany. The dips is the financial crisis in 2009, and then we had the COVID dip in 2020, and of course kind of the confidence in European industry is kind of not super high, and we see kind of it's quite bad in Germany. And also now in October, the German government came out and said, okay, 2024, we expect it to be kind of another recession year, and also kind of that we will first kind of see a growth in emissions next year. So of course, kind of it's not kind of a super bright picture when it comes to the demand side in the EU ETS. Another driver that is kind of not necessarily kind of fixed to the demand side or the supply side, but the overall kind of sentiment in the carbon market is kind of the interest in investment funds. The commitment of traders data that comes out like every week shows the positioning of the various market participants in the market. We like also often to kind of watch what the investment funds are doing. It's not necessarily they don't have to be in this market for compliance reasons, and we see kind of that's a kind of a price or is affecting kind of also the price. Earlier this year we kind of had the shortest net open interest for investment funds from kind of the data we have. We also see that the investment fund open interest is kind of very highly correlated with the movements in the EUA price. So of course, kind of this is important for the market, especially in times when there's kind of not really kind of any clear directional signals to the carbon market. But then going into a bit kind of the 2024, of course, we are going into winter. So market is preparing for winter. So of course, kind of the weather forecast is going to be increasingly important. Typically, kind of it's less important in the shoulder seasons. But now we will have, I mean, will we see colder weather? Will we kind of have high heating demand? Will we see kind of more wind leading to a higher amount of emission-free power generation? And of course, kind of also, so the new weather forecast coming in will kind of be an important price driver to both kind of the fuels and power market, but also carbon. Also, gas storage levels and gas supply will be of importance also for the carbon market. We're getting into winter. What about kind of what's the levels? I mean, we're high levels at the gas storage levels are currently high, but will we see kind of where will the LNG go? Will we see competition for LNG coming to Europe? Unexpected outages, for instance, from Norway, that could of course kind of make the market nervous as well. Some carbon specific things. We have the EUA auction supply coming up in December. That's kind of happening every year, that half of December, it's kind of without auctions. Normally that's kind of at least kind of this psychological effect, like this bullish psychological effect. And also the December option expiry is often kind of influencing the market, especially kind of towards like the second half of November into December. The chart on the right is showing the December option expiry at the moment. Currently, like the balance between the calls and the puts are around 74 euros. But of course, kind of getting closer to expiry, we will see kind of movements in the option expiry market to influence also kind of the carbon price. Then Repower EU. So that's kind of EU's plan to kind of get was the response of the EU to the Russian invasion in Ukraine, how to kind of speed up the dependency on especially Russian gas and fossil fuels, and part of that plan is funded by the sale of Repower EU, or sale of allowances to fund the Repower EU. So that's 20 billion euros will be raised by the sale of auction volumes. We've had kind of the first batch came to the market in 2023. We have like 87 million tons being auctioned this year to raise money for the Repower EU, and also kind of next year it's scheduled to come the similar amount of volumes, and also some volumes for 26. But of course, since it's a monetary target, what's kind of been auctioned so far is below kind of probably the expected price of 75 euros. So we don't know for sure what the European Commission will do, if they will kind of up the volumes for next year, or if they will remain the same. Our view is that European Commission will leave the volumes as they are at 87 million tons. But of course, we don't know this for sure. And if they should add more volumes to next year's auction calendar already from January, that decision will kind of be announced to the market already in Q4. So that's kind of something to just look out for 2024. And of course, something not carbon related at all, and is the US election. But of course, that could have an impact on the overall sentiment and equity markets that will then again influence fuels and carbon markets. Our price forecast for Q4 is an average price of 69 euros, so a bit up from where we currently are at the moment. And also kind of the fuel switching curve also suggests that we have coal in the money, both kind of for spot front month and also kind of the front quarters. Then looking further ahead, focusing on 2025. But when focusing on 2025, we also need to look slightly longer. The chart here is showing the balance in the EU ETS from the outset when we started in 2008. We've kind of seen that the oversupply has been building up, and then it's kind of being reduced again, especially with the entry of the Market Stability Reserve in 2019. However, if we look at the annual balances, we see that in 2025, we are kind of a long year, so more supply coming to the market than we anticipate from the demand side. However, in 26 and 27 and 28, we are kind of facing shortage in the years, and that is of course kind of because EU ETS is a cap and trade system, and the cap is set by the European climate targets. So of course we know that in 2030 it's like the overall target for EU is at least 55% below 1990 levels. 2050 is in the climate law, it's net zero. So of course kind of these are setting the boundaries to how soon the cap is reduced, and that is kind of influencing also kind of the number of supply coming to the market over the next few years. We do expect that we will continue to see a rapid decarbonization in the power sector, but that also means that we have like less fuel switching potential left in the system, and that will be kind of exhausted when we're getting close to 2030. That means we are kind of facing massive abatement efforts that is needed across industry sectors. And the cost of industry abatement will be the price setter of the system. But then I also want to kind of bring up, so that's kind of the why kind of going forward. That's kind of where we need to also kind of focus a bit on why it's getting shorter in the next few years. The market stability reserve is an important instrument. The market stability reserve is a structural tool that was kind of implemented in 2019 to tackle this structural oversupply in the market, but also to cushion kind of the effects of demand shocks and also kind of shocks in the market. So of course, kind of that helped to kind of clean up after COVID, for instance, when demand was dropping, and then MSR was okay. This is kind of a demand shock, so kind of soaking up some of that surplus that was building up in 2020. That's the same thing that is happening now these years, where we'll kind of see a lot of repower volumes being injected to the market. Also kind of lower emissions keeps kind of the market stability reserve kind of active. It will kind of tackle this kind of situation with the market or responding to this demand shock and also supply shock. Of course, it works with a lag, so that will kind of be quite active in the years when supply is getting extremely tight, because in 2026 is the last year where you will see kind of Repower EU, last bits of Repower EU volumes. 2027, you already kind of lent allowances to the market because Repower EU volumes is just like front-loading allowances, also with the cap being decreased quite aggressively by the year. So kind of the double whammy effect with kind of MSR being on top of an already like tightening system will kind of, that's why we see this annual shortage and kind of that the overall shortage is going lower. But then back to 2025. The theme song for 2025 will probably be should I stay or should I go? On the one side, we have MSR responding to lower emissions and Repower EU volumes. We have the cap is reduced every year by 84 million tons. Then we have the new shipping sector that was kind of introduced into the EU ETS this year with 40% of emission covered. Next year, 70% of emission covers. And then you have like some nitty-gritty details like the maritime cap will be retroactively fitted. Fuel switching curve now suggests that coal will be back in the money. I put a question mark because that was the same thing at this time around last year. And then suddenly we had a shift. And then kind of the annual shortage from 2026, which I just discussed in my previous slide. On the bearish side, of course, Repower EU volumes is injected to the market, to a market that doesn't really need these allowances at this point of time. Slow economic recovery, and the amount of emission-free power generation will be key. Okay, of course, also kind of if carbon is just like faithful to gas, and gas will kind of continue to be the main driver, that might be the case as well. And a bit kind of on the horizon of the market participants. So where do we land on this here? We have our outlook. We have the anticipation of future shortage. We believe that this will outweigh the short-term bearishness that we currently are facing. And our forecast is quite much up from where we currently are. So our average price for next year is 95 euro per ton. But that will be, should I stay or should I go? I think that was it for me.
Yeah, thanks. Clear statement, clear outlook regarding the price level. Definitely, this is definitely an interesting point to end up. And getting now into the discussions, we have already received some questions I will pick up, but at this moment as well, yeah, please, dear audience, feed us with some exciting questions you want to get discussed here. I will pick up a few things. What is definitely interesting and not just debated here in around EUAs, but as well on the gas market is the influence of financial players being active in the market, driving the market, maybe having different kind of reasoning sometimes why they become active and see prices move. There's one concrete question. Could you explain a little bit more how the open interest is affecting the prices exactly? What are the mechanisms you see? Is there a clear
I mean, it's I think it was like a few years ago when it started to be kind of a focus area for the ones in the carbon market. Of course, kind of the commitment of traders data is coming out kind of after the position has changed. So it's not necessarily kind of reflecting today's kind of change. But it has been a focus area from the market, and typically kind of when the investment fund, and it has been especially on the investment funds because they don't really need to be in this market. So of course, kind of they can go in and out and exit anytime, right? So it has been quite a lot of focus on the investment funds, and I will also kind of, especially when they kind of see changes in the positions, typically read by the market in some way or the other. Typically kind of when they build short, it's kind of a risk of short squeeze, then you suddenly see kind of prices are jumping on that fact. And then other weeks you really don't see kind of that logic hitting the market. So it's typically kind of, I would say it's it could also be kind of if you talk to quite a lot of market participants, they kind of bearish carbon, but long term or a little bit kind of further out, they're bullish. Of course, kind of it can also be used as an indicator to, okay, when is kind of the momentum shifting? Is kind of, can you mirror that momentum shift also kind of in the investment funds when they kind of start to build kind of their long positions and kind of reduce their short position? But yeah, at least kind of it has become, I would say, especially in quiet times, it has become quite a kind of a one thing that market is looking at. And it's a bit like when you have when everyone is looking at the same numbers, then you're reacting to the same numbers as well. I guess it's a bit like technical analysis. If everyone is reacting to the same kind of theory behind technical analysis and the levels, then it becomes reality.
Yeah, there's more questions. If you, to sum it up, one question is here: are the financial players driving the market, or are they merely reacting? Which one would you lean towards?
I would say it could be both. In sometimes, I mean, it's of course kind of being part of the price formation as well, and being kind of part of the driving prices, or maybe kind of fueling the price increase or the decrease. And then in other periods, it's other drivers that is, or other market participants that is more kind of driving the market as well. But of course, they're playing into the price dynamics as well as the other market participants.
Yeah. Another big driver, well, the second big one is gas, as we discussed and you explained. We have seen this enormous correlation in the first half of the year between gas prices and EUA prices. It became a little bit loosely tied together in recent weeks, months, exactly when we are in fuel switching territory. So it's a little bit contradictory to see this development. Is this already telling us for 25 that gas prices will have less of an influence in terms of volume and price setting ability, or how do you see this evolving in 25?
I mean, you saw kind of our price expectations for 25. We think also kind of the fundamental picture that you will see kind of the structural kind of shortage that is coming to the carbon market will need to be priced in. At least that's our view. I mean, there are kind of, I think it's a hard year next year to predict or kind of forecast prices. But in that sense, we think kind of that the correlations will kind of be limited. Of course, there will be some dynamics, but that we don't think gas will be kind of the driver, that we will see such a high correlation that we've seen like the first half of the year when it was like crazy. You could be a gas analyst and then you be completely correct if you kind of got the geopolitical pinning down all the geopolitical tensions as well. So of course, kind of we think that the correlation will kind of be not as high for next year.
makes the market more interesting, definitely, no? To see more factors. If we take the position of an industrial player with the need to hedge for forward prices with the price increase you do predict, do you see buying activity happening now from industry? I hear sometimes 60 euros is kind of the buy at the dip moment. Do you see this heating up, that there's more hedging activity?
Yeah, I think I mean it's I think it's like a bit I mean, industry players are quite diverse, and some have like a hedging strategy in place, but I have like a bit kind of the same as there are people in the market that thinks levels that we have seen this year is kind of profitable, or kind of is a good good time to secure kind of the carbon price risk, especially with industry. I mean, from 2026 they will have like, and their free allocation will be further reduced due to the benchmark improvements. Also, kind of quite a lot of the sectors will be exposed to CBAM, which will reduce their free allocation even further. So of course, kind of this kind of exposure to carbon price will be even more prominent for industry players, and I think quite a lot have at least kind of knows this and have kind of strategies in place to tackle this.
Yeah. You mentioned CBAM, and we have here as well got some questions around the international nature of let's say the carbon markets being not yet connected, but potentially being more connected in the future. CBAM being the most prominent, I think, way of internationalizing European decarbonization efforts. How exactly do you expect CBAM to influence the market, the volumes? Can you be more precise on that one?
Yeah, so it's a bit kind of tricky to, I mean, of course, kind of CBAM will be linked to the carbon price. I mean, it will be CBAM certificates that the importers to Europe needs to kind of pay a certificate price equivalent to the EUA price. So in that sense, of course, kind of so that there you have like direct link anyway. Of course, kind of it will also depend a bit kind of on the various sectors, because of course the CBAM is meant to not favor necessarily European industry. It's meant to favor kind of the cleanest one and give incentives to the cleaner producers in all sectors. Of course, kind of in Europe we have kind of in some sectors we have the cleanest production in most of kind of the world. So of course, kind of putting exposing imports also to a carbon price will then be kind of profitable, or kind of should be in that sense profitable for European producers, and then for others it will be vice versa. But of course, kind of giving this visibility of a carbon price, because the free allocation is the other measure, right? That you could do like a carbon leakage to avoid carbon leakage, to avoid kind of European industry moving out because you have like a carbon price here. Looking at the cap, I mean, the cap trajectory is going to zero in 2040 with under the current rules. Of course, kind of that means if you were continuing with free allocation as well, that is, I mean, you will have less and less free allocation to hand out and avoid kind of the carbon leakage. And you also want to give the push to European producers to clean up their industry as well, to be like competitive in the future, being part of the green shift that is needed. But yeah, so if it has an effect on price, probably like it will kind of be probably some behavioral shift within like the European industry based on CBAM. We haven't really kind of pinpoint like a price action or kind of price point to the behavior of CBAM. What we could see potentially is like some price hedging risk, because it's so linked, that we could see some participants hedging the CBAM price with the EUA price. But of course,
international industry basically being exposed to CBAM, adding volumes to the market. Yeah.
Yeah.
already seen or expected? Not yet, no?
I mean, difficult to say if it's seen, but it's we know there is kind of trading happening outside of Europe that is kind of also kind of interest in carbon because of the CBAM. So some are probably getting like slightly involved into that space.
Maybe moving a little bit as well to the political policy setting sphere here. I mean, we will get a new commission, or we have a new commission in the making. With the elections, there has been a move to the right. We hear more and more positions as well from the parliament, where the strong support for the ETS as the cornerstone kind of element of decarbonization is questioned, or let's say is discussed with the competitiveness of European industry. From what you see and hear right now, do you expect any changes to the target set and the mechanisms in place arising from the new commission?
So I think for the 2030 targets, that's pretty much cemented. Like the Fit for 55 target is going to be, I mean, it's so deep into everything. So that will require like a massive effort if you want to kind of loosen up that for the ETS. So for the 2030 target, that's kind of in place. What is maybe kind of will play a part is, of course, kind of we will discuss the 2040 target. I mean, we have the 2050 target in climate law. The 2040 target, which is like bridging the gap between 2030 and 2040 is, sorry, 2050 is the one that will be discussed, I mean, next year. And of course, kind of, we know that the commission or the previous commission in their communication, they said at least 90% below 1990 levels by 2040 was their recommendation based on the scientific board. So of course, kind of, but they also kind of in the impact assessment, they gave like 3 different scenarios which they had modeled. One with the current policies, which will hit like 88% reduction in 2040. And then also kind of a scenario where you just draw a line from 2030 to 2050, which is the least ambitious scenario, where you kind of think you do kind of equal amounts every single year. So of course, there is a risk that you will kind of not necessarily agree on at least 90% target for 2040. But anyway, kind of let's say that you go for a less ambitious target for 2040, it still kind of needs to be like massive shift, especially in the industry side. It's kind of the new industrial kind of revolution that needs to take place, and that's why kind of also the focus is on industry. So that's kind of going to be like the challenging part, but that's what they're going to discuss. And I think anyway, of course, it can be translated like bearish to the market, but anyway, I mean, just looking at like the balances and what you need to achieve, even with the least ambitious target, that's pretty like quite a heavy lift that needs to be done on the industrial decarbonization.
But if you look on the short term now till 2030, you see there's limited ways of political leaders to influence really the price, maybe besides Repower EU, or have to keep prices low. What?
Yeah, of course, always kind of like these political signals, if there are significant and, you know, significant policymakers, significant policy groups that kind of group together and give kind of a statement saying this or this, it's always kind of, even if it's like not necessarily kind of going to happen anytime soon, that gives kind of a signal to the market. So of course, kind of, if you go for a less ambitious 2040 target or something else, then of course that will influence the market, even if the market balance stays the same or kind of the cap stays the same until 2030. That's kind of course, kind of policy is, I mean, it's a policy tool. So of course, kind of it's policy made, so it can be policy changed in that sense. So of course, kind of the statements from policymakers will kind of make market participants kind of worry, or I mean, a bit kind of back to when we had like Ursula von der Leyen coming out with the Green Deal saying, okay, we are going to be like the first climate neutral continent. We are kind of, and by that we need to improve the 2030 target. And just by kind of giving that kind of signal, that was kind of already giving kind of quite the price increase or price support. And also when that became kind of even more ambitious, then she kind of, I mean, she said like, it will be something between like 50 and 55%. And they went for at least 55%. So of course, kind of, yeah, it's a bit kind of what horizon are market participants looking at? A few years ago, much longer time horizon. And now it's been kind of, this year, it's been very kind of short-sighted. But of course, kind of policy and policy signals is always important for the price formations.
Yeah. We get one interesting question I want to bring in. I haven't thought about this myself. For the 2040 target discussion, is there a role for carbon removals to play? Is this part of the longer term strategy?
Yeah.
Because 2030, it's not part of the discussion yet, or part of the system in a way, no?
Not part of the system for 2040, but it will be discussed, and we think it's likely that it will be part of in some way the EU ETS up until 2040. I mean, just looking at like if you continue with the current rules, like with the cap going to 0 in 2040, I mean, that might change. I mean, it could be like slightly later or slightly earlier, who knows? But I mean, we don't expect emissions to be 0 in both industry and power or shipping or maritime for that sake in 2040. So you need some room of flexibility. And then the desired option will be carbon removals to kind of net the gap and tackle these kind of these emissions that is hard to abate or kind of impossible to abate. So to get some flexibility into the system, and I guess kind of the challenge there is, do you have like, is supply meeting demand with kind of, you don't have necessarily kind of the rules, will it be allowed, what kind of types will be allowed? I mean, there are a lot of kind of things to clarify, and also supply needs to also kind of get the right signals to build up. And of course, it's, I mean, the carbon removals is probably not only the EU ETS that will require those, I mean, to want to kind of have some access to negative emissions. I mean, it will be a challenge also for the sectors that are not covered currently by the ETS 1. That might be like ETS 2, like buildings and transport, agriculture, other kind of sectors outside of kind of the European economy as well. So, but we're pretty kind of confident that the removals will play a part in the discussions how kind of the system should look like after 2030. Yeah,
very interesting. And maybe as well, looking a little bit more ahead, the ETS2 is coming, and we do have, just citing as well the German example, we have a national system as well in place, where it got a little bit silent what's happening there regarding trading and open markets. How do you see these potentially interacting, ETS 1, ETS 2, and these national systems in place? It's a very complex topic overall, but maybe you have some clear beliefs there.
Yeah. No, it's it's very interesting because, of course, kind of ETS, I mean, we are looking at a system that will be equal in size as the ETS 1. Of course, kind of different. It's quite different as well in with, like, it's been kind of upstream with the fuel supplier that will kind of be the compliance entity. But of course, kind of we are we think it will kind of be quite different price-wise, at least kind of over the first few years. Of course, kind of for the ETS 2, they will start kind of front-loading some of the allowances. So not to start with kind of a very short market. So we think this kind of oversupply that will kind of be in the first few years will kind of limit kind of the price in the first few years. I mean, it's also kind of some mechanism that you will pour more volume into the market from market stability reserve if the price reach like some trigger points. First of all, that will be kind of the inflation adjusted like 45 level in the beginning. If you kind of hit that over like a time period, then you will kind of inject some more volumes to the market. However, kind of what we see of our emission trajectory for both kind of transport, building, and small industry is that we are getting kind of looking at the supply and demand. We are soon getting into a quite tight market, and also kind of because you borrow these allowances only kind of from 20 let's say that's 29 and up to 2031. That's kind of where you hit kind of the shortage quite soon. So in order to, I mean, in the cap and trade system, you can't be short. So it's so you really need to kind of have a carbon price then to clear the market. So we're looking at, especially kind of around 2030, 2031, that the market will require quite high carbon prices in order to clear the market. So I think kind of how we see it is that ETS 1 will have quite high prices when the ETS 2 starts. So that's when we have like the peak kind of annual shortage years in ETS 1, where we kind of have like a quite comfortable system in ETS 2 in these years. And then when market stability reserve become less active than 28, 29, 2030, when it's getting more balanced in ETS 1, that's when you have the really high shortage in ETS 2. So it's going to be, I mean, it's going to be interesting to see when it starts trading, how kind of price discovery will be. But that's kind of at least the balances, what they're telling us, that they're quite kind of different. Of course, there will be discussions to merge the two systems. I mean, we're looking at kind of going to 2040 and beyond. It's going to be limited amount of emission that is covered, and also kind of the size of the system and how to kind of trigger the most or the most cost-effective abatement across the whole economy. So of course, kind of there will be discussions on merging. I think that was probably the grand idea when they were creating the system anyway, that you will have like a similar carbon pricing within Europe. But first, I think it needs to start trading, and then we have to see kind of how different the two systems are, because how we see it now, pretty different.
Yeah, very good. On your slide regarding 25, you gave us a hint on the perfect closing question, I would say, the US elections. So give us in a short way your view on how this could affect the market. Is it Kamala? Is it Trump? How does that, if there is any clear reasoning, how that could affect the markets?
Yeah, good question. And I'm not the US expert, probably not kind of the best one to. You can probably answer that in as good as I can. I think, I mean, of course there will be a reaction in the markets, and maybe like green markets. Who knows? With Trump, maybe kind of the green markets will kind of be. Or kind of the confidence in the green instruments will get hit. But the overall sentiments, maybe kind of a boost if Trump wins, who knows? But that's, I mean, that it will be some noise around kind of the election, and that could potentially kind of impact the carbon price as well. I mean, that's a bit kind of what we saw when we had like COVID. I mean, everything in Europe went down, and then carbon was going up because it was following macro in the US or oil or whatever. I mean, it was just like taking direction from something completely unrelated to carbon. And that's typically kind of what we could see happening in the days after the election and the election outcome.
Great. Thanks for trying to answer that as well. Look, it was an amazing session. I think we could discuss for hours here. And I have to apologize as well to the audience not picking up all the questions. We got a lot here, and we have a lot of amazing participation today. So at this moment, just big thank you to you. It was really great. Thanks for everyone tuning in here as well as audience and participating with the questions. hope to see you all soon again for the next webinar. Thank you.
Thank you.